My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make a little bit of money here. My job is not just to entertain, it's to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Something is not right, and we got to talk about it. Remember what happened last year when speculative stocks took over the market? They climbed and they climbed and they climbed ever higher as complacency and overenthusiasm took over the field. I called it the year of magical investing. I said, enjoy it while it lasts because it's going to end and end badly. Sure enough, in the middle of October, speculation peaked. And the year of magical investing came crashing down. I bring that up because we've had a huge run here, a run that continued today with the Dow gaining 115 points, S&P advancing 0.26%, NASDAQ edging up 0.36%, and those same speculative stocks, unfortunately, are leading the way. But let's pull it apart so I can tell you what's really going on because I don't want you to get hurt. First, as I explained last night, we've come up real far, real fast. The rally's now long in the tooth by every single admission. Nevertheless, there are plenty of people who get too enthusiastic right about now. Every time there's a rally, they think that anything they buy goes higher. They actually think they're geniuses. They lost all discipline. They're too cocky. Same as last year. Cocky is not a positive trait when you're buying stocks. They know nothing! Incredibly, what did these people get excited about today? The exact same stuff that first made and then lost them tons of money last time. Nuclear power, quantum computing, and space. Look, I love nuclear power, but even with a more favorable regulatory environment, it's just not a great business. Building nuclear plants costs too much and by the way, take way too long. That's why the vast majority of publicly traded utilities want nothing to do with them. Not after the disastrous Southern Company, which had severe overruns when it tried to finish the last 2 out of 4 nuke projects that it had. It took 15 years for Southern to build 2 nuke units, thanks to design complexity and problems with the supply chain, as well as bankruptcy of the builder. It became a joke. Everything that could go wrong did go wrong. The original estimate, $14 billion. Final cost, about $36 billion. Look, I'm not dismissing nuclear power. If you want clean energy, it is your best solution. I'm just saying that because of its complexity, you need to go with bigger companies that aren't going to go bankrupt during the construction. The other night, a stock screaming ran looking for discounted growth named Service Vistra. That's a very good independent power producer with plenty of nuclear exposure. I'd buy it. I also like Constellation Energy, which is trying to restart 3 Mile Island. The company knows nukes, has a bunch of nukes in its fleet, and I think represents decent value at these levels. I also like GE Vernova as well. That's the power plant maker, which is building a small-form nuclear reactor in Ontario. And it's also partners in building a nuclear reactor plant for the Tennessee Valley Authority. GE Vernova is a terrific company, and we talked about that today at our monthly CNBC Investing Club meeting. We're comfortable with the numbers and the time frame. How about the quantum stocks? I believe that one day quantum computing will be very important, but today is not that day. Right now, the publicly traded companies are just science projects. They all talk a big game. But again, the only viable quantum businesses belong to Google, IBM, and Honeywell. I own Google for the charitable trust. I also think IBM's a terrific buyer. Honeywell is spinning off its quantum business known as Quantinuum later this year. It owns 54% of it. It owns a little more than 50, but it's a very valuable asset. Space is easier because of the mammoth IPO of SpaceX, brought to us soon by Elon Musk, maybe later this summer. I think it's going to be a huge hit. In the interim, anything that looks like SpaceX should go higher, including Rocket Lab. I'm blessing Rocket Lab because it's got a $1.85 billion backlog, giving them terrific visibility to the future, although it was up a lot today. Needless to say, to get your hands on any SpaceX might be difficult, but I think it'll be a better performer than Tesla. Why am I so adamant that speculation is getting out of control again? Well, Exhibit A has to be a company called Allbirds. I got a pair of Allbirds in my closet. They're not doing anything. When I bought them, they were cool. Not so much now. These, I think these New Balances, I have a problem with my ankles. These New Balances, I think, are a lot cooler, frankly. 6 weeks ago, Allbirds seemed to be headed into the dustbin of history. Stock was at $2 and change. A company's losing fortunes. It has been ever since it came public. It doesn't make any money. But rather than shut down, it did something I'm sure it thought was genius. Allbirds sold its shoe business to American Exchange Group and announced a definitive agreement with an institutional investor for a $50 million convertible bond, which, and I'm quoting from the release here, will enable the company to pivot its business to AI compute infrastructure with a long-term vision to become a fully integrated GPU as a service and AI native cloud solutions provider, end quote. Yep, they pivoted from casual shoes to AI, and they're changing the name to New Bird AI. The company sees a need for more compute, and it's going to bridge the gap. They say that New Bird AI will, and I quote, initially seek to acquire high-performance, low-latency compute hardware and provide access under long-term lease arrangements, meeting customer demand that spot markets and hyperscalers are unable to reliably service, end quote. Oh, I got it. There's a compute shortage, and we know who to call, a casual shoemaker. Who would know more? I can't think of anyone better positioned, say, to negotiate toe-to-toe with Taiwan Semiconductor or go at it hammer and tongs with Jensen Huang from NVIDIA for chips than the Allbirds people. Think about it. They know last. They know canvas. They know rubber soles. Those are three of the most valuable traits when you're butted up against Michael Intrater or CoreWeave, right? Oh, and of course, they probably think that if Intrater wants a Bitcoin miner can switch to a data center manager, why can't a shoemaker do the same thing? Of course, there's a simple answer. Bitcoin miners already run data centers as part of their business. Allbirds wasn't even a successful shoe company, for heaven's sake. Yet the stock rallied nearly 600% yesterday on this Bafo news story. It does have me thinking, though. Nike's been a real tough stock to own. Why not open a Jordan line of GPUs? Just do it. Maybe On Holding could do a line of always On Holding that could rival CoreWeave. Maybe the way for Under Armour to get back in the game is to go all in on GPUs. CEO Kevin Plank once owned a liquor business. He's versatile. Seriously, you want exposure to this area? Last night, Taiwan Semi, the actual maker of chips for NVIDIA, said that CPUs are in short supply. That means go buy AMD and Intel like everyone else. Those stocks are up a lot, but it's certainly better than buying this convert. The buying the stock. I mean, I just think that, well, you know how I feel about this. Oh, no, wait a second. I got a better idea. Instead of buying Allbirds, maybe buy NVIDIA. Call me crazy, but when it comes to GPUs and service, I want to go with Jensen, not with the really nice people from Allbirds. I just think he knows more and has a real sense of the industry. Allbirds couldn't even figure out footwear. And I have still one more idea. Allbirds, I'm an idea machine. Allbirds is basically creating an all-new company here. It's doing so without any vetting, any actual scrutiny, because there's a publicly traded shell that it can creep into. Before this gets too far down the road, maybe the SEC gives the bird people, a jingle and suggest maybe, I don't know, review the company to be sure it isn't just a colossal joke. Look, I'm a free market guy from way back, but the bottom line is this one's a speculative bridge too far for me. New Bird AI belongs where all birds belong. At the back of your closet, if not a cage. Norma in New Jersey. Norma.
Hi, Jim. How are you? I try to buy part of my stock portfolio with stocks that I know, and I'm a customer, and I use the product. I know you always recommend that, and so I tried to do that. The stock that I own and want to talk about is Cava. I enjoy eating in their cafe. I find the food fresh and good value for a fast food restaurant. I purchased Cava at 88. Hold on. And I'm really in the red. Your opinion, should I buy more?
You're in the red. Cava's at 91. You're not in the red. You're doing great, and I totally agree with you. 212 Cava. I just think it's exactly what you said. I think it actually might be the next Chipotle. I want you to hold on to it. And if it comes down, I think, Norma, you should buy more, and thank you for calling. How about we go to Eugene in Ohio? Eugene.
Booyah, Jim. 26 years watching Mad Money.
Holy cow, thank you.
Burlington, Ohio here. Jim, my play is on Snapchat, ticker Snap. With EU investigation.
No, there's nothing there. Let's just I've been fighting this Snap now for I don't know how many years, saying don't invest in it. And so far, I'm looking pretty good, frankly. Let's go to Rich in Texas. Rich.
Hey, Jim. Hello from Helotes, Texas. How are you doing today?
I'm doing well. How about you, Rich?
I'm doing great. Hey, listen, I bought this social media company at $141 and wrote it down to $120 under fears of the New Mexico judgment against Meta and systemic profitability concerns. But with its recent deal with Nectar Social, it's clear that Reddit's profit and growth will expand. But given the hyperbolic gains of $42 a share over the past weeks to $162, has it gone too far too fast?
No, Reddit should not have been down that much. I wish Steve Huffman would come on because he knows how much I think Reddit is a very, very valuable company. And I got to tell you, if I had a bigger company that I could and snap up that $31 billion business, I would do it. I think that you can train on their stuff. It's very exciting. Yes, it's been up a lot in the last week, but so have many other stocks. I really think that is one that you want to own. Okay, guys, listen to me. The symbol is bird, all right? I am all for free markets, but what's happening with Allbirds is just one speculative bridge just too far from it. On My Money tonight, shares of Shake Shack have been put on the back burner this year, but could the burger chain start serving up some big gains for you? I'm taking a closer look. Then, wow, it debuted today, Madison Air Solutions. You hear them people going like, Matt, when I was trying to do the show at 9 o'clock and they wouldn't let me think? That's okay. I don't need to think. I can just do it. I read cue cards. Actually not. But I'm running through the name to tell you if it's a buy. And Broadridge plays a pivotal role in keeping our financial markets running. So why has the stock been taken to the woodshed? I say we talk to the top brass to find out. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Everybody likes Shake Shack, the burger chain that started as a hot dog cart in Madison Square Park. You know, and that's why the stock's been so frustrating. When you walk into a Shake Shack, there's usually a line, and it's one of the best burgers you can get. Yet if you bought $1,000 worth of Shake Shack 5 years ago, you'd have only about $850 left today. I mean, talk about a suboptimal return. The company was doing great when COVID showed up, but the pandemic gutted their business, and it took 3 years for Shake Shack to become profitable again. Even after the world reopened, Shake Shack still had to prove more to Wall Street. Investors became less willing to pay up for companies that felt special, but didn't look efficient enough. Then the GLP-1 weight loss worries hit, and consumers also started pushing back against high prices. Shake Shack ain't exactly cheap. I mean, you're going to spend at least $20 if you want a real meal, a burger, fries, and a soda. It's a premium fast food chain. There are not a lot of those. It's hard to figure out what the peers are, but that does mean you pay premium prices. I bring all this up, though, because I think the business has improved dramatically in recent years, something that's not really reflected in the share price, even with the stock's nearly 23% bounce year to date. Let me set the scene. After the pandemic, the business only really got going again in 2023, when Shake Shack's revenue hit $1.08 billion, with profits of $16.2 billion. In 2024, the revenue climbed to $1.253 billion. Net income still growing to $40.5 million, despite rising beef prices. Then last year, revenue hit $1.445 billion, and net income jumped to $58.3 million. So, I mean, long story short, with that trajectory, I think Shake Shack's back. Now, a lot of that is thanks to Rob Lynch, a guy we've had on the show a bunch of times. He's just terrific. He took over as CEO of Shake Shack in March of 2024 after a long stint running and I think turning around Papa John's. When Lynch took over, he didn't inherit a broken brand. He got a beloved brand that simply needed better execution. That's the opportunity here. You see, Shake Shack never had to fix the product, its burger. It never went bad. It had to fix the machine around the burger. And that's exactly what Lynch has been doing. He's great at that stuff. You can already see some of that deeper in the numbers. The company's restaurant-level margin got to 22.6% for the full year, driven by operational improvements, supply chain savings, and labor efficiency. Build costs for new stores came down 20%. That matters a lot because investors don't just want more locations. They want more locations with better returns. The stock's now up nearly 23% since the start of 2026. There's a real chance that Shake Shack reports again in early May. Same-store sales will come in at the high end of expectations. Helped by value offers, we love those, menu innovation, and improving trends over the course of the quarter. But even if the quarter's strong, management may not rush to raise their full-year forecast because beef prices are rising. and their international licensing business has meaningful exposure to the Middle East. That could potentially give you a buying opportunity, but I have to tell you, it's going to hurt the numbers. Long term, though, I think Shake Shack's biggest advantage is the fact that they haven't alienated their customer base like so many other restaurant chains, which have, they took the price up a lot of these places. People got very upset. Most chains spent the last few years leaning too hard on price. They kept pushing menu prices higher and higher, sometimes because they had to and sometimes because they could get away with it. In the process, customers felt ripped off. While Shake Shack's kind of always been on the expensive side, they were less aggressive with the price hikes, and they always made sure to keep some cheaper alternatives on the menu. Now, historically, Shake Shack is underinvested in marketing. Now that they're firmly profitable again, there's a real push to spend more on ads. I think that's a smart move. This is a brand that still has lots of room left to widen its audience. And then there is the operational stuff that matters more than people usually realize. This is not just about ads and new menu listings. It's a throughput issue. They're getting faster and tighter in the stores. Ticket times have improved. Kiosks now account for more than half of the in-Shack. I can even use the kiosks. I actually figured them out, and I'm terrible at kiosks. Labor deployment's gotten smarter. There are small equipment changes and kitchen changes that can improve speed consistency and get rid of waste. Now, none of that's flashy, but it improves throughput, and throughput's the name of the game in this business. Of course, that does not mean the risk is gone. The biggest swing factor for Shake Shack is still beef. The stock's been heavily tied to cattle and beef costs. It's the stock more than the company, okay? Which is one reason why it's been such a frustrating performer in recent years. If beef spikes, the margins get hit, and then the stock gets punished. That's right. But even if Lynch is doing a good job, even if traffic's holding up, even if the long-term unit growth story is improving, this thing can still get clipped if input costs move against them. That's just the reality of the business. I saw it with Texas Roadhouse. And for the past few years now, beef's been moving in the wrong direction. There are also some macro considerations we got to talk about. The World Cup could matter, especially given how many Shake Shack locations sit near host cities and high traffic areas. I don't want to overemphasize that point. This isn't Constellation Brands, which will make a fortune from the World Cup. But it's fair to say Shake Shack may have more traffic help coming this summer than the average burger chain. Then there's the all-important store growth. Shake Shack put up 45 new locations last year, and this year it's expected to grow its footprint by around 15%, with cash-on-cash returns moving toward 50%. If the company can keep getting better unit economics, then this stops being viewed as a recovery story and starts becoming the great growth story that it used to be. Of course, the stock's been a disappointment for 6 years now, but that's exactly why I think it's really interesting. The expectations got reset. The story got less romantic. The market got tougher. And in the middle of all that, the business actually seems to have improved dramatically. That's why I think Shake Shack should not be held down forever by its reputation. If CEO Rob Lynch keeps doing what he started doing, tightening operations, lowering build costs, protecting the customer relationship, spending more intelligently behind the brand, and scaling without messing up what made Shake Shack special, then this can absolutely become one of those stories where the company quietly fixes itself up before the stock really caught on. Doesn't mean Shake Shack will go straight up. I told you, I can't emphasize enough how tough beef is, okay? The high-priced earnings multiple here also can still hurt them. One bad quarter can still knock the stock around. But the bottom line, when you zoom out, the picture looks pretty clear. Shake Shack was doing well, got floored by COVID, then sales came back first with profits lagging. Now it finally looks like the turnaround may be real. I know I'm a believer, and more importantly, I am a satisfied customer. And money's back after the break.
Coming up, the largest IPO of 2026 so far just dropped. So should you be buying in? Cramer's looking into Madison Air to see how fresh it could be. Next.
With the market now fully recovered from its Iran-related weakness and back to setting fresh all-time highs, it makes sense that the IPO window would open again. And sure enough, today we got the largest new listing of the year, the IPO of Madison Air Solutions. That's MAIR for you home gamers, which is a commercial airflow and cooling company. All right, this one's intriguing because Madison Air plays in some really attractive end markets like semiconductor production, advanced manufacturing, and, of course, equipment for the data center. That's why tonight I want to walk you through this story. Pictures of windmills, can't beat that. Let's start with the basics. Madison Air calls itself a, quote, leader in the mission-critical indoor air solutions market. Are you mission-critical? I'm mission-critical. Offering its customers advanced airflow and cooling technologies that, quote, deliver superior air quality and tangible results, higher productivity, lower energy costs, and improve operational performance in the most demanding environments, end quote. Their business includes a data center cooling unit, a division that purifies air for semiconductor fabrication facilities, a commercial high-volume, low-speed fan business with a name I can't repeat on air, and a couple residential-focused brands that think air purifiers and humidifiers. Overall, 63% of Madison Air sales come from commercial products, with the other 37% being residential. Now, sometimes companies can go a little overboard in creating a story for themselves, a bit of mystique as they come public, and some of that's happening here. Madison Air said in its prospectus that it's focused on ROA, or return on air, which they define as the tangible value created when air becomes a strategic asset. They cite all kinds of stats to elaborate on this. Their equipment can save up to $9,000 per minute by preventing downtime for data centers. Clean room airflow control can reduce contamination incidents by up to 30%. Standardized test scores go up as much as 5% for students in classrooms with improved air quality, and so on and so forth. I gotta tell you, I'm unmoved by this idea of ROA, return on air. There's no need for Madison Air to overhype itself like this. At the end of the day, we're talking about a company that makes high-quality products for a series of attractive end markets. What more do you need, frankly? This is basically a successful roll-up that's made a bunch of smart acquisitions over the past decade to build itself into an airflow and cooling powerhouse. That's the best way to think about Madison Air. It's a shrewd roll-up with an attractive set of industrial end markets. It's somewhat similar to Forgent Power Solutions, another one we like, the roll-up of the electrical equipment space, which was the largest IPO of the year until Madison Air came along. So that's the basic story here. How do the numbers look? Honestly, pretty good. Making some adjustments to smooth out the numbers after the acquisition of April Air last year, we can see that Madison Air's pro forma revenue grew modestly from $3 billion in 2023 to $3.1 billion in 2024, but then jumped to $3.5 billion in 2025, a 13% increase from the prior year. The fact that Madison is accelerating revenue growth, makes the story even better. Company's also solidly profitable, with their EBITDA margins rising from the low 20s to the mid-20s over the past few years. Pretty good. What else? First, the balance sheet looks fine here. Madison Air is going to use all the proceeds from this IPO, meaning over $2 billion, to pay down debt. After that, expects to have about $3.3 billion in net debt and a leverage ratio of about 3.5 times, which is not bad at all in this industry, especially from a roll-up. The company also has strong cash flows, and I like to see that it had $4.39 billion in orders last year. And it ended 2025 with a backlog that was just over $2 billion. Again, the numbers are overall really strong for Madison Air. So this company's got a good story, impressive financials. But what about the valuation here? If the stock shot up more than 17% today as part of the debut, the deal price is 27 at the high end of the proposed range. It took a long time to get the stock open. Today it opened for trading at $32 before finishing the session at 31 bucks, 31 and change. I think the best way to look at the valuation for Madison Air is with what's known as an enterprise multiple, measured as enterprise value. Enterprise value means that's the market capitalization plus net debt divided by earnings before interest, taxes, depreciation, and amortization. For anything capital intensive, that's a more informative way to look at things than the price earnings multiple. We have to use last year's numbers. Not ideal, I know, because we don't have enough information to come up with even a back-of-the-envelope forecast for 2026. I want to compare Madison to Vertiv, another company I really like, a leading supplier of power and cooling equipment for the data center, as well as three classic heating, ventilation, air conditioning, or HVAC companies, Carrier Global, Johnson Controls, and Trane Technologies. When you stack these stocks up against each other, I have to say that I think Madison Air looks pretty darn reasonable. At nearly $32, the company has an enterprise multiple of around 20. That's well below Vertiv, but it makes sense as Vertiv has better earnings growth and is strictly a data center and industrial story. An enterprise multiple of 20 is basically in line with the three classic HVAC players I mentioned, which have enterprise multiples in the range of 16 to 25, despite the fact that Madison has the best EBITDA growth of any of these companies last year. So, you know what? I think MAIR or MAIR can be bought right here, right now, even after the stock's strong debut. Buy! For an initial price target, I'll throw out $41, which would give the company roughly the same valuation as Trane, the most expensive HVAC comparison here. Of course, we'll have to see how the estimate looks once the analyst quiet period ends, but I'm pretty optimistic about this. In fact, because I like the story and because I like the ticker, I'm going to do something that I don't usually do, except for really well-established companies like Microsoft, Mr. Softy, or, of course, NVIDIA, which is the name of my late dog. I'm going to give Madison Air Solutions a nickname, Mayor of Easttown, after one of the best HBO shows in recent memory. Most authentic Delaware County, Pennsylvania accent impression that I've ever seen, painfully authentic, even as I am from bordering Montgomery County. But here's the bottom line. The market has bounced back, and now the IPO market has reopened for business with the largest deal of the year. Fortunately, it was a good one. I like the Madison Air story. I like the numbers, and the price still looks fine to me, even after solid pricing and a good open today. Even after this move, I think Mayor of Easttown is a buy. All aboard! Sam, Pennsylvania. Sam.
Jim, so I got a stock here at Enphase Energy. It's a stock that I've been invested in for a while. The company has been struggling recently, but there is a rebound going on. What's interesting with the company is that they have a 2% margin headwind that they attribute to the tariffs. Of course, with the IEEPA ruling, those tariffs are now, what has been a headwind is going to be a tailwind. So I'm curious what you think about the potential for margin expansion as a result of this 2% expansion. And I also want the company's management to look into selling those inverters to potential data center customers. So.
Well, maybe they should do that. This has been such a disappointing stock. The other day, Sam, we talked possibly about First Solar. I know you don't want to hear that. You're looking more at Enphase, but we think First Solar is better. And I tell you, Enphase has just been a disappointment for too long. Let's go to Ronnie in North Carolina. Ronnie.
Hey, Jim. Long-time viewer of your show. Enjoy it very much.
Thank you, Ronnie. What's going on?
Not much. Got my question on Cisco. I held Cisco for several years, but the share price just seemed to grow very slowly. However, looking at it right now, it's like it's up about $27 a share over the past year. So with their interest, their investments in AI, do you think they're a good buy, a profitable buy?
Yeah, I do. Now, we did sell for the Chapel Trust Committee, nice game, but we have so much data center, I felt like that we were taking on too much. Talk about that in today's meeting. I think you're in great shape with that, Ronnie. It's doing very, very well. Chuck Robbins doing a terrific job there. All right, look, I like what I'm seeing from Madison Air. I think the stock can be bought right here, right now. I don't know if you listen to the CEO. She's pretty terrific. Now, there's much more made money, including my sit-down with Broadridge. The fintech player has been a champion for retail investors for years. I'm learning more about the company where it's headed with the CEO. And investing in tech might seem like the only way to get ahead in this market. But tonight I'm digging into one household name that deserves more attention from investors. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. One of the most exciting things about being a shareholder in a publicly traded company is the fact that, at least in theory, you get a say in that company's affairs through your stock's voting rights. But far too often, investors don't even take advantage of it, or maybe they can't. That's why I want to talk to Broadridge Financial Solutions. It's a financial technology company that helps banks and brokers operate more efficiently, communicate more directly with their clients, while also processing proxy voting for some of the largest companies in America. They've made a big push to increase shareholder voting participation, which you know we like here, especially for retail investors. At the same time, Broadridge is the stock. I don't really get it. It's going down 40% from its peak last August, including a 27% decline year to date. We're going to find out about this. It's one of the many professional services companies that's been hit by AI displacement worries, not facts. So let's take a close look with Tim Cook. He's the CEO of Broadridge Financial Solutions. Tim, welcome back to Mad Money.
Oh, Jim, thank you very much. It's great to be here today.
All right, so Tim, there's a lot to talk to you about, but I don't want to talk about the decline in the stock yet. You're doing something that is very interesting, which is tokenization. But I think a lot of people, when they hear that, they say, oh, I don't understand that. I wish they would just talk about plain old. But it's too exciting. And you're involved with Mr. Novogratz, who's a really terrific guy.
Yeah, we're excited about this opportunity. We think it gives retail investors another choice. I think it's going to draw more investors into U.S. equities, foreign investors, younger investors, people that currently have coin. But as you know, being able to vote is one of the core things about owning an equity.
Right.
And it can be complicated. And we're going to simplify all that for retail investors, but also for the public companies who are going to be facing sort of incoming votes from a variety of different channels now, and bring all that together to simplify it for them.
Okay, but what is tokenization? What does that mean?
Well, it's a representation of an equity, and it can be either issued natively on-chain, which is sort of a new technology, or it can be a representation of a traditional equity, which would be immobilized someplace, but then represented on-chain so that it can be traded real-time 24/7.
All right, so that would be something that maybe younger people would be interested in, because it's like they're facile with that. I don't know if the older folks would really be that focused on this. Maybe they would.
They may be. It depends. You know, there are people today that have a lot of say Bitcoin or other holding that may want to hold equity, so they want to see it all in one wallet. Also, foreign investors.
Oh, okay, that's right. I mean, particularly, I know we had a fellow that was represented African gaming, and they would feel much more at home with this. And I don't blame them, especially because some of their currencies are not that strong. What is with the announcement with Galaxy earlier this month that I saw? I thought was pretty revolutionary.
Yeah, we are excited because Galaxy is a core company in this space. They have shares that are both traditional shares, but they also have natively issued on-chain shares.
Right.
We're going to be providing the voting for those on-chain shares for their annual meeting, which is coming up in just a couple of weeks. So we are going to be providing the full end-to-end voting for on-chain shares. And again, we think tokenization is going to be a real tailwind for our company because as it draws in new investors, we're going to be able to do that whether they're tokenized by the company, the way Galaxy is, or whether they're tokenized with a broker-dealer or an exchange.
Now, how are you at helping us get some voting rights if we have our money with an index fund?
Well, great point. I'm really glad you raised that. You know, voting choice is something that is really growing. So, one of the issues, if you're a fund holder, is, well, how do you have your voice be heard? And over the past few years, it's really developed to enable retail investors to have their voice heard. We did this for 8 funds 3 years ago, 100 funds 2 years ago, 400 funds last year, 900 funds this year, worth $4 trillion in assets. And what it allows you to do is to express sort of a choice among several different policies to say, broadly vote my shares in line with that policy, and really gives retail investors that choice.
Now, how much money do you make per, vote or by a contract that you make with the company? Is that how it works?
Yeah, for voting choice, it is it's a technology service that we provide to the asset manager, and so it's a negotiated fee, sort of as for the platform that provides it.
Okay, all the things that I'm hearing don't seem to be things that Anthropic would hurt or OpenAI, but your stock is clearly reflecting a drag from from AI. Can you tell me, has anyone knocked on the door of any of your clients with a superior product? Because otherwise, to me, it's just something that doesn't make sense.
Well, look, I'm glad you're raising this because I think it's a real opportunity for Broadridge shareholders. I've been a buyer myself, and it is true that many SaaS companies, particularly ones that have a seat-based model, where if the number of people go away, the number of seats would go down, have been hit. And I think we've been somewhat caught up in that, but we're very different because, as you point out, what we do is we connect thousands of public companies to hundreds of broker-dealers to literally almost 200 million retail investors, and that's not something that is going to be vibe-coded away. And on the contrary, AI is actually a tailwind for us because we can move faster, we can provide more new products, which we already are with real revenue today, and it's going to be a great source of efficiency for ourselves and for our clients.
Well, when I checked research, I didn't see anyone who was just thinking you're endangered. I mean, look, I get it. Like, Intuit, I didn't think it was endangered, and then Perplexity sends me a ballot and what it could look like, or it tells me how to write up my taxes. I mean, is someone sending me a mock ballot and I just don't get it, like from one of these?
We are not seeing anything, Jim, and it's when you think about the connectivity that you have to provide, the end-to-end auditability, all the regulatory reporting. This is a highly regulated area, so. Again, we feel this is just really much more of an opportunity for that a threat.
Okay, and can you talk about your program with Exxon, which is a stock that has actually had a great performance?
Yeah, this is, again, another really exciting development that gives voice to retail shareholders. So as you know, retail shareholders hold about 30% of shares.
Right.
They vote at a lower rate because as convenient as we make it, it's still lots of buttons to push.
Right.
What this allows people to do is to sign up to say, look, it tends to be that retail shareholders vote with management because if they don't like management, they just sell the shares. So it allows them, and we're used to defaults in other parts of our life, to basically subscribe to say, hey, I'm going to get the materials, but if you don't hear from me, I want to vote with management. And it makes it much more convenient. And what we've seen is nearly 10% of Exxon's investors signed up in the first go-round this year. That's going to build over time. And as we look across all the data, we're seeing that about a third of those are new voters that haven't voted before.
Well, you're making it commonsensical. I'm in favor of common sense.
This is really one of the very exciting developments.
I'm waiting for Anthropic to really decide, you know what? I'm going into Broadridge. Not going to happen, Tim Gogi, the CEO of Broadridge Financial Services Solutions, whose stock is down 40% for, I'm going to say it, no reason at all.
Thank you for that.
Quite welcome. Ned Mike's back after the break.
Coming up, you've got questions, Cramer's got the answers. Get charged up for a fast-fire lightning round. Next.
It is time for the lightning round. Save this song, set bye. Sell, just a course. That's on my step. But you play this out. And then the lightning round is over. Are you ready? Tell the lightning round. Let's start with Marty in Arkansas. Marty.
Yeah, we appreciate
Marty.
what you do for retail.
Thank you. It's everything to me.
All right, my company had 2025 revenue of $12.4 billion. It's in a growth phase to transform from legacy telecom into the digital AI era. Recent business partners announced Microsoft, Google, Palantir Cloud, and yesterday AWS. I'm asking about, can they come back from the ashes? Lumen. Yeah.
You know what? You know it better than I do. I know it's from Monroe, Louisiana, and I've always felt that it was a decent spec, and you qualify it by putting out a lot of interesting customers there. I'll go with you on that one. Let's go to Mara in Florida. Mara.
Hi, Jim. Thanks for taking my call.
Okay.
Oh, I'm good. Thanks for taking my call. I learned a lot from your book.
Oh, thank you.
I have a very modest portfolio. Anyway, I'm thinking of selling my Venture Global stock and buying BKV Corporation stock. What do you think?
Oh, geez, I like Venture Global. I think Venture Global could, I didn't like it initially, but it's come down. Look, the world is going to be a changed place. Venture Global has the LNG. The carriers. I'm saying don't make that move. Let's go to BK in Massachusetts. BK.
Professor Cramer, this is BK. By the way, I want to say that you brought so much energy this afternoon at the monthly meeting. I got fired up to pull trigger on few
Thank you.
But
that was a fun call. I tried to bring a little acting to you. I wanted to get things rocking and rolling. Thank you. Thank you.
Yes. Anyways, so I wanted to get your thoughts on Poet Technologies.
Poet Technologies. Now you come into the quick. I do not know Poet Technologies. I am not a poet, and I don't know it. Okay, let's go to Robin in Michigan. Robin.
Hi, Jim.
Robin.
My husband Tom and I love your show. We watch it every single night.
Thank you.
Yes.
Oh, that's great. I feel great about that.
Oh, awesome. So I bought this stock a few months ago. I sold it. Then I bought back in, and now I just don't know what to do. And this stock is Fastly.
At 6, I was recommending this thing, and then it went up to like 35. It's at 24. I think it's a buy. I do like Cloudflare more. I've been reading Matthew. He's been posting some interesting things on Twitter. I think. Oh, geez, it was up 7 today. Hold on to the Fastly. Hold on to it. But if it goes down, buy more. At 5.6, it was just way too cheap. Let's go to Mary in Illinois. Mary.
Wow, Mr. Cramer, thank you for taking my call. Okay, I have a question about a financial real estate investment trust. It's ARR. It's a $2 billion company with a PE of 5.32.
I've known it for a long time. I don't understand why the yield's so high, and it does concern me. I know that higher rates don't necessarily help it. I've never really been a big fan, but I can see that you wouldn't want to own it. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Coming up, has PepsiCo cracked the code to succeed in the new consumer packaged goods space? Cramer's popping the top on what's working. Next.
Tomorrow, kick off the trading day with Squawk on the Street. Live from Post 9 at the NYSE.
Like the old days, David.
What were the old days like, Jim?
Unmedicated.
Really? Nothing? Not taking anything today?
Sometimes you have to be real.
It all starts at 9 a.m. Eastern.
Do we spend too much time talking about tech? I think we forget that big gains can come from all sorts of areas. Isn't a 3% gain in PepsiCo the same as the 3% gain in NVIDIA? This morning, PepsiCo's Ramon Laguarta put on a clinic about how to grow earnings in a group that we've all, for the most part, given up on: consumer packaged goods. From escalating raw costs to a consumer who feels hard-pressed about spending on expensive snacks to pesky competitors taking share, we've learned not to trust these companies when they tell us everything's fine. But Laguarta's lesson is quite different. He tells us you can win by innovating and win by paying attention to detail. These traits, coupled with a consumer that might have changing tastes, are allowing PepsiCo to triumph over all sorts of adversity. Hence the $3 and change rally today after a better-than-expected quarter and a solid outlook. Let me walk you through the details here because I think it's an important story. PepsiCo is a complex company and doesn't lend itself to easy analysis. There's Frito-Lay, the snacking business. It's the chief mover of the stock. Then there's the beverages led by Pepsi, but also, of course, with the inclusion of Gatorade, which had a total facelift today. The company's been challenged by a multitude of hardships. There's the younger consumers' newfound affection for foods that are natural and organic, not really Frito-Lay style. There are people who are on the GLP-1 weight loss drugs, which makes them avoid binge-eating junk food. There's a whole cohort that's been priced out because of all the willy-nilly price increases in the food aisle. They're rebelling. Now, some of these headwinds have dissipated. We're seeing some behavior changes among people on GLP-1s. They seem to have accepted that they aren't going to eat as much as they used to, but it hasn't changed taste. The salty snacks still taste good to them. You just can't eat as many. The answer is smaller packages. That's what Ramon figured out. A small form factor pack of chips with a good price is crushing it here. The price differential of a smaller bag has worked for more than just GLP-1 users. It seems like a great deal for consumers who are tired of inflation. Second, Ramon's winning with innovation. The fast hydration system of Gatorade, faster to hydrate than water, was just introduced. I think it's going to be a home run. There's acquisitions like Poppy, a more natural drink that's doing quite well. The analysts seem a little clueless about these changes, though. Most focused on how Ramon's been able to control costs in an era when film that contains the chips and the plastic and aluminum that the drinks come in could have caused runaway inflation, but didn't. Having been through COVID, Ramon's learned how to source from around the globe, and he's hedged on aluminum until the end of the year. Plus, PepsiCo's scale allows him to crush on price the smaller players who can't keep up with the sourcing, and they certainly aren't hedged on aluminum until the end of the year. So Frito's taking share. He's confounding the analysts who are mostly focused on gross margins, not the bigger picture of PepsiCo's business. They seem to be expecting the same shortfalls the other food companies gave them, not with this one. What Ramon's work shows is that you have to be inventive. You have to be willing to cut price, which he ultimately did with the chips, by the way. And you have to source from around the globe. Oh, and you need some luck, like the changing attitudes of consumers on the GLP-1s. That's how you get a PepsiCo-style upside surprise. At the end of the day, you should always look for wins wherever you can find them, whatever aisle they're in. And there are plenty of wins outside of tech. The bank doesn't asterisk that money. Go make some of it. Like I said, there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC or its parent company or affiliates and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.